One of the biggest surprises of this year has been the strength of the American economy. At this time last year, equity markets were fearing a recession, but such concerns have proved misplaced. US GDP growth was 4.9% on an annualized basis in the third quarter of this year after inflation, and 8.5% including it. Personal consumption, corporate investment, and government spending all rose. The only negative was trade, where imports exceeded exports once more as America bought more than it sold. In many ways, the consumer is key, because personal consumption represents around 2/3 of US GDP, and in the coming week, therefore, all eyes will be on the latest US monthly retail sales figures. They're due on Wednesday the 15th. In September, retail sales growth accelerated to 3.8% year-on-year. The balmy days of 2021 and 2022, when stimulus checks drove spending into the double-digit percentage growth range, well, they may be gone. But even so, the current rate of growth suggests the US consumer is in rude health, especially as those numbers are again in real post-inflation terms. The nominal figures are more impressive still. That said, there is one other number to watch when assessing the October retail sales figure when it comes out, and that's the personal savings rate. Some economists are arguing that the drop here, as stimmy checks are no longer available, is a sign that US consumers may at some stage have to cut back on their spending. Meanwhile, earnings season is just beginning to quieten down in the US and Europe, where around a sixth of the FTSE 100's members are due to release full-year or interim results or a trading statement in the coming week, and a good selection of small and mid-caps are expected to do the same. It's therefore going to be busy, and names which may be worthy of further attention include the following, pending any last-minute changes in the dates. BAE Systems and British Land on Monday the 13th of November, Imperial Brands, DCC, Informa, Convatec, Babcock, Land Securities, Vesuvius and Essentra on the 14th, SSE, Diageo, Experian and Tullow Oil on the 15th, Aviva, United Utilities, Burberry, London Stock Exchange, Halma, Smiths Group, Spirax, Sarco, Premier Foods, Kia, Kinetic and Keller on the 16th, and Max Electrical and Fuller Smith & Turner on Friday the 17th of November. Even allowing for that lengthy list, however, the company which could just cause the biggest fuss in the week ahead is Vodafone. The telecoms giant and FTSE 100 members slated to release its first half results for the 6 months to the end of September on Tuesday the 14th. Now, the shares are down by a quarter over the past year and are trading no higher now than they did in 1997, just before the technology, media and telecoms bubble of 1998 to 2000 really hit top gear. May's full-year results didn't help sentiment much, even though new Chief Executive Margarita Della Valle launched her Customers, Simplicity and Growth strategy. That was because the boss cut profit and cash flow forecasts for the year to March 2024 and forecast yet another year of unchanged dividends. July's first quarter update didn't really stir investors either, as total reported sales growth was minus 4.8%, although in fairness underlying service revenues rose 3.7% year on year, helped by broadband price increases in Germany and a strong showing in South Africa and Egypt. The trend in group-wide organic sales growth is the first number to which analysts will turn in this second quarter and first half batch of figures. After that, the numbers themselves and the outlook statement will be judged relative to the downgraded guidance offered in May for Vodafone's own preferred performance benchmarks, which I must stress, neither of them are indeed statutorily accepted. The first is UEBITDAL, which stands for Underlying Earnings Before Interest, Taxes, Depreciation, Amortization and Lease Expenses, or in other words, earnings before a lot of bad stuff. That's expected to come in for the full year at €13.3 billion, down from $14.7 billion in fiscal 2023. The second piece of guidance offered is that adjusted free cash flow will come in at around €3.3 billion before spectrum costs. That compares to last year's outcome of $5.3 billion, although Vodafone will say that changes in corporate structure mean that that benchmark isn't appropriate and the drop will be much lower. That then takes us to the dividend, which is paid in euros. After a big cut to 9 euro cents a share in the year to March 2019, the first ever reduction in the company's distribution, Vodafone has kept the payment flat for 4 years in a row, and the firm's targeting a fifth straight unchanged dividend for fiscal 2024. That implies an unchanged first half payment this time around of 4.5 euro cents, although currency movements may mean the figures move around a bit more in sterling terms. Note that this final graphic does show the dividend progression in pence. Finally, analysts will look to strategic matters. The Spanish business is now to be sold, and rumours of a merger with Three in the UK refuse to go away, while activity in other markets is also possible as Margarita Della Valle looks to refine the company's portfolio of assets. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.